Charles, good to have you with us. You're had a long and distinguished career, and I want to begin by asking you to define your definition of value investing. It's a term everyone uses, but people have various definitions of it. So what is your definition of value investing?
Well, the basic definition is the belief that there are, at times, discrepancies between the intrinsic value of the company and the price at which that stock trades. And so sometimes we try to identify companies when there's a large gap between the price of the stock and what we think the real value of the company is. Having said that, we have always had a bias towards better businesses, in other words, those that are able to compound their value over time. And one of the advantages
of harder to find.
Those are much harder to find, obviously,
companies.
than the net-nets, the cigar butts Ben Graham talked about. But if you can find those, the beauty is that time becomes your friend. If you buy into an average or mediocre business, you need that price, that gap between the price and value to be closed as quickly as possible. You need, the old, man to die. You need a new management to come in and restructure the business. You need a catalyst. Conversely, if you own a compounder, then time becomes your friend. And we also have a clear bias, Steve, towards companies with significant insider ownership. We believe that eating your own cooking is a very powerful thing, whether it's us as money managers or...
Talk for 1 second about what you do about eating your own cooking.
Well, I eat quite a lot of it. I think collectively, the 42 people that work in our firm have north of $100 million of our own money in the funds we manage, which for us is a significant amount.
Those are two funds.
Those are two funds, one which is global, the whole world, one which is international only. And so,
international being non-US.
Being non-US, right. Again, so we do believe, and it's been proven historically, that companies with insiders, when insiders own a lot of the shares, tend to do a much better job. They care more, they have a longer term vision. And so if you want to invest in companies with significant insider ownership, these companies tend to be smaller, or at least the float, what trades in the market, what's not held by the family, may be smaller. And so we need to be able to, you can't get in and out of these positions easily, so in principle, you have to be willing to hold on to these shares for many years. And so you need to believe that the intrinsic value of those companies can grow to some extent over time.
Now, how do you do your screening, so to speak, especially since you do the whole world?
Well, most value investors do their screening by focusing first and foremost on the price. They try statistically to identify cheap-looking stocks that trade at a low PE ratio, stocks that offer a high dividend yield, stocks that seem to trade at a low price-to-book basis. And once they've identified all those cheap-looking stocks, they do their homework, one stock at a time, try to identify among those cheap-looking stocks which ones have somewhat decent businesses. Because the problem with these lists of cheap-looking stocks is typically those stocks will fall into two categories: either the worst companies in any business, or the most mismanaged companies. Now, conversely, our starting process is different. We start with the quality. We want to investigate companies where we believe the business is a good one. So I'll give you an example. Many years ago, I stumbled upon Thomas Nelson. Did not know anything about it, but I figured, gee, it's a book publisher, a book publisher, and I figured, gee, that has to be a good business, not much in the way of author rights. And then I prayed that for a reason or another, the stock would be cheap. And optically, the stock did not look cheap. The price to earnings was quite high, but I noticed that there was a weird accounting quirk whereby there was a huge amortization of goodwill, which in fact was a non-cash charge, and one could adjust the earnings per share for that. And if you look at the cash EPS as opposed to reported earnings per share, the stock looked much cheaper. So we whenever we read about a business that seems unique or uniquely good in its field, we investigate and hope that the stock is cheap. Now, maybe it's a company with 3 divisions. Maybe 2 divisions do well, 1 does poorly, and yet most investors may look at the company in aggregate and may unduly punish the company. A good recent example may be a Seal there, where a company that does the bubble wrap and they have other divisions. One of the three divisions has not been doing as well as the others, and I think that's why the stock went down recently to $14, $15, and it has been able to bounce back since.
You once dismissed metrics like EBITDA. You focus just on what you call free cash flow.
Well, yes. I mean, EBITDA is earnings before depreciation. Now, most businesses need maintenance capex to stay in business, and so we focus a lot on free cash flow. And today, for instance, if you look at companies in the oil and gas industry or gold mining, the sad reality is that the production costs have gone up a lot, including capex. To replace an ounce of gold in the ground or to replace a barrel of oil of production, you need capital spending that's 2, 3, 4 times what the company is depreciating, which means that the reporting, the real earnings, the free cash flow is a lot less than the reported earnings. So I think looking at free cash flow is a good starting point.
You also do something that seems to contradict value investing, and that is you exploit volatility. When you think of value investing, you think of holding a stock forever, but you go in and out depending on.
Yes, Steve, but I think you're right. A lot of people associate value investing with buy and hold, but I think it's wrong. Yes, as a value investor, you have to be willing to hold onto a stock for 3, 4, 5, 6, 7 years. So you need a mental outlook where you're willing to sit on it for a long time. It may take a while for the price to meet that intrinsic value, and hopefully that value will have grown over time. But at the same time, if markets are volatile, and if the price of that individual security meets its intrinsic value right away, you should get out of it. So yes, so I do cringe when I hear about buy and hold investing. And in fact, in a low return world, which I believe is the world we live in now, I think volatility should be exploited. Now, volatility...
Well, go through what you did with Japan recently.
Exactly. So Japan has witnessed this huge rally that started mid-November when the new Prime Minister, Mr. Abe, came on board. I think the market rose 55% until May 21st. Then the market proceeded. So as the market went up, some of the names we own started to reach our intrinsic value estimates, so we trimmed them. But then as the market corrected 22% after May, we started buying back mostly the same names we had been selling, and in one instance we started buying into a new name. And then more recently, until a week or two ago, the Japanese market had bounced back enough that we had become net sellers again. So I think volatility, you're right, is like a razor. You can put it to good use. You can use it to make yourself look good, or you can, in other words, you can use it to buy low and sell high, or you can put it to bad use. You can catch yourself with it. I.e., buy high, sell low.
Did you come up with your own formulas to determine intrinsic value?
No, I mean, I think to go back to the Ben Graham definition of intrinsic value, it's what a rational buyer would pay in cash to buy an entire business. So we rely mostly on M&A multiples, private market transactions. So when a company such as Heinz, the food company, gets acquired, we monitor at what kind of multiple of revenues, of earnings, free cash flow, the takeover takes place. Having said this, we are aware that there are times when money is loose, when credit is abundant. There are times when corporate acquirers themselves overpay. And we try to be mindful of those times, and when we think that happens, we will use multiples that are less than actual M&A multiples. In the case of the Heinz deal, Mr. Buffett himself recently at the shareholders meeting in Omaha acknowledged that it was easier for him and his Brazilian partner to pay 15 times EBIT because part of the deal was financed issuing bonds, high yield bonds, yielding only 4.25%. If they had had to issue bonds at 8%, they would have had to pay a much lower multiple.
You seem to have a lot of issues. Some value investors focus on a few. You have over 100 in each of the funds.
Yes. Now there are two reasons for that. One is that we have a strange investment philosophy where we believe that the best way to compound wealth is by avoiding the losers and minimizing losses. And so one tool to control risk is to have more names than if we were concentrated. Now, having more names does not mean that we don't know our companies. In fact, quite a few of our companies have been taken over the years, and the takeover price has been very close to our estimate of what the value of the company was. But the second reason, Steve, is that we are global investors. And even though we invest a lot outside the US, and even though corporate governance has improved overseas over the past 30 years, even though disclosure by companies has improved a lot overseas, the sad reality is that it's still very far from perfect. And so as a minority shareholder, which the funds are, to protect oneself, we need to have more names than we would in the US. I'm not sure I would sleep well at night if I had 8% of my fund in one Japanese name or one Korean or one Indian name.
In terms of overseas investing, one of the challenges is accounting issues.
Well, accounting issues are, in my mind, have been over-exaggerated. In the sense that accounting issues are a problem if you're a growth type investor who only focuses on earnings and earnings per share and earnings growth. Value investors are used to looking at the totality of the financial statements. They, in fact, oftentimes will start not so much with the income statement, they may start with the balance sheet in conjunction with the cash flow statement. Value investors spend a lot of time trying to reading the footnotes, the devil's in the detail. And so whatever the accounting standards are, if you look at a company's numbers over 5 or 10 years, you cannot not notice if they generate free cash flow or if they don't. So to me, the real problem with foreign companies is not and also accounting standards have been somewhat harmonized with international accounting standards. So the real problem is not accounting, it's the disclosure. Foreign companies do not have 10Ks.
Right.
I'm always interested to know if the company owns its headquarters or leases them or other lands or stores. And also when companies have different businesses, the divisional breakdown is not as good typically overseas as it is here. So that's the real flaw. Again, one way to mitigate that risk or cope with it is to make sure that the individual positions on specific names doesn't get outsized.
Everyone preaches discipline in investing, but you are practicing it in sometimes a very painful way. You talk about equities as the best house in a bad neighborhood, but that doesn't mean you're going to go in all equities. You have a very high position in cash. Yes,
to argue that equities are the best house in a bad neighborhood was a way for us to say that cash has little appeal because after inflation the return is negative. Same thing with high quality bonds, and so it stands to reason that when cash and high quality bonds yield so little, it becomes very tempting to be fully invested in stocks, but that would remain a relative argument. And so for a value investor today to claim that this time is different because interest rates are so low, and therefore because this time is different, there's no need to insist on a margin of safety, on a discount between the price and the intrinsic value would be tragic. If you go back a few years ago in 05, 06, I was amazed by the number of companies, including financial institutions, that had become more and more levered financially. Of course, the extremes were Fannie Mae and Freddie Mac that were levered 100 to 1. But even GE and many other companies had become more and more levered financially. And yet, there's a cardinal rule of value investing, which states that it's not enough for a stock to be cheap. For it to be bought, it has to be safe and cheap, to use the words coined by Marty Whitman from Third Avenue. And yet the universe of stocks that were safe kept shrinking, and after a while value investors said, it's not fair, let's forget about that rule, let's own those stocks. And then the 08 financial crisis came and it hurt. And again, I don't want to be remembered as the guy who decided that one of the central rules of value investing, which is that there's a need for a discount, I don't want to be remembered as someone who has decided to ignore that rule on the basis that interest rates are very low.
Now, how do your clients react? You have a lot of financial advisors. it's fine, but they're always looking at what you've done in the last 6 months, 12
Now,
months.
we are blessed to have great clients. I mean, they've known my team and I for many years, whether it's at IVA or wherever we used to operate before. So we have clients that understand we're quirky, that our goals are, in a way, even though we're long only, we have the goals of hedge funds in the sense of trying to deliver positive absolute returns. We have a history of having delivered on those goals. We were able to cope quite well with 2008. And they understand that we're not a hedge fund in the sense that we do not short securities, we don't use leverage, but they respect and understand that we need tools such as the ability at times to hold cash, the ability at times to hold gold, the ability at times to own tiny companies or at other times to own mostly large ones. So they are on board and fully respect how we operate. Our fees are much lower than fees of hedge funds, and
your own background, France, South Africa.
well, the accent may be difficult to decipher. I was born a French citizen, but in fact my father was stationed in Morocco when I was born. But the key happened when I was 5 years old. My family moved to Johannesburg, South Africa, where I had to go to school there. So I had the blessing of a solid Anglo-Saxon upbringing to help offset some of those bad French influences. Then I did enjoy 10 years in Paris. It's a beautiful town after all. In the late 70s when I was in Paris, I mean, socialism and communism was still a threat. And it was a joy to come to New York in 1982 for a long internship, which I did with Jean-Marie Eveillard, who became my mentor, and to feel in America, though the entrepreneurship juices flowing, to see the revolution that took place after Reagan gained power,
right,
was exhilarating. And I've never looked back. My wife's American, and I sometimes notice some of the excesses that may happen in the US, but I think it's still the greatest country, and I'm thrilled to be living here.
Now, talking about discipline, you closed the funds over 2 years ago, and they're still closed today.
Yes, our firm manages 18 billion, which may not seem like a lot of money, but the fact is that our investment approach means that we like to be eclectic. There are times when the best bargains in equity markets are among smaller stocks. It was certainly the case in the US in 99, 2000, 01, for instance. There are times when we like to buy high yield corporate bonds, late 08, early 09. These bonds are not necessarily that big or that liquid. And so if we were to manage 50 or 60 billion, we would no longer be able to buy into those smaller names. So it's for that reason that we've closed our funds.
No plans to start a new fund?
No, I mean, if we start a new fund, it would be basically that new fund would steal ideas that would belong to the original funds. I mean, I could, launch a high yield fund, although I'm not sure that would be the right time, or Japan fund. Again, whenever we find a cheap high yield bond or a cheap Japanese stock, those investments should go first and foremost to our existing funds. So I think it would be wrong to consider opening a new fund.